Further ado then, guys, let's start. Um, so hi everyone, I'm Michael from the South African Chamber of Commerce here in Singapore, and we're joined by our wonderful guest speaker today, Marisca de Bruyn, down in Cape Town. Marisca and I have been doing this talk now for 5 years. So once a year for the last 5 years, we've hosted a call like this to try and give out complimentary free information to all the South Africans abroad about what is happening in the realms of taxation in South Africa following the budget speech each year. And there is a huge amount of changes, and what was the case 3 years ago, or 5 years ago, or even a year ago, is not the case anymore. Every year, what we are seeing is progressive changes into a slightly more aggressive way of collecting tax, and they're looking at how can they raise tax income on taxes for the government, and they're now looking at how do they come after the people living abroad, I suppose. And so as part of kind of disseminating good, unbiased advice about this situation, we do this talk. And look, there's a lot of fear mongering that is happening in the world, telling you there's no way to escape this or avoid this, or SARS is coming for all your money in your bank account. This is simply not the case, and it's definitely not something to be afraid of. And if you are empowered by this information that we have today, you would feel less stressed about all of it. But it's important to have good advice from a really good team of financial and tax professionals who understand the complexities of these situations. Marisca and I have helped. We were calculating it just now, almost more than 50 South Africans living overseas now, since we've been doing this. And what is really cool, and I did, like, it was in the registration portal, when we're going to run through a really cool presentation we've worked on today, but afterwards everyone gets a free e-guide like this. You perhaps can't really see properly, but basically on here it has all the all the information we're going to be discussing today, in detail, and yeah, you can just read it on your iPad. So without any further ado, I'm going to share our e-guide for this year and get into the topic of conversation for the day. Right. So as mentioned, I'm Michael, but not only do I work for the South African Chamber of Commerce, or volunteer as it is, but I'm also a certified financial planner. And for the last 5 years, I've been working with South Africans all over the Asia Pacific region to help them understand their investment planning, retirement planning, and also measures they can take to protect themselves against unnecessary taxation, not only from South Africa, but other jurisdictions too. I help people come up with their plans. We're joined by Marisca, and Marisca is the Director of Mint Accounting in Cape Town, but she's also a qualified tax advisor for South Africa. So Marisca, I'm going to ask you to unmute, and could you introduce yourself and just tell people a little bit about what you guys are doing with Mint?
Thank you, Michael. Yes, so I'm a tax advisor who specializes in international tax. So I help South Africans who are all around the world to understand how their tax obligations work in South Africa. And we at Mint do seizing of residency. We've got a full-time team who helps lots of people to seize their residency and just to assist them with the correct information, and especially not with fear-mongering information. And I'm also a member of the South African Chamber of Commerce.
Awesome. And Marisca is very humble about their team. It's a really great team, and they do a lot of things. So we're going to go through a couple of processes today that you need specialized advice for, and her team can really help with all of it. But outside of the topic of just, tax and income tax specifically, we do other talks, and these are all available on the South African Chamber's YouTube channel. So you can visit there, and when you get your e-guide, you'll hover over this and you'll see it's got links to the YouTube videos. So for example, we did a workshop on South African pensions. which we're going to have to redo after this budget speech because everything's changed again. And then another sort of interesting topic that we discussed previously is a lot of South Africans want to buy property in Australia and potentially retire there. How do you do that? It's all on the YouTube channel. Again, all complimentary. And we put this information out there to give value to our community. So let's get into this 2024 budget speech and all the things that have come about. There were a lot of changes announced, and there's a lot of things that are going into discussion. And these will only be finalized later in the year. But from a headline point of view, there's quite a bit for non-residents or people living overseas to consider. So I'm just going to zoom in a little bit. There you go. The first thing, there's been no changes to personal income tax tables or medical tax credits or retirement tax tables, which is a little bit surprising considering the amount of inflation that we're facing globally. You would think they would revise that on an annual basis, but they did increase it in 2023, so perhaps that's the reason for not doing it again. And they've also introduced further amendments to this whole two-pot system to South African pension funds, provident funds, retirement annuities, how they all work. And this has to do with this, what they're calling the harmonization of retirement products in South Africa, because they want us to be in harmony with our money. So further to this, some anti-avoidance rules, which has to do really with the nature of moving money into trusts or loaning money to trusts to avoid potential taxation. This applies mainly to South African tax residents and not to people who are non-resident. So we won't spend too much time on that, but it's important to be aware. And there have been some slight changes to the foreign tax credits, which could potentially impact you. But this is still being tabled and it hasn't been confirmed, so we won't go into too much detail on that today. So what we will be going into quite a lot of detail, and Marisca will be sharing her infinite knowledge on two big topics, and that's this approved international transfer process, which is now moving money out of South Africa and the steps you have to take to do so, and the two-pot retirement system and how that works. There have been some other changes that we'll briefly touch on. One of them being tax-free savings accounts and retirement product contributions and the limits to the contributions you can make in the year that you cease your residency. So before we move into the details of those two next processes, Marisca, after this budget speech and having read through this, what are your takeaways and what do you think are very important things for people that are non-residents living overseas?
Michael, I think probably the biggest one, starting with the distributions from a trust, is that a lot of people put their assets in a trust for estate duty purposes, planning, and then also there's the flow-through principle where you are able to either have assets earning income, which you could then distribute to your beneficiaries, and the beneficiaries will have an interest tax payable between 18 to 36%, 45%, I'm sorry, 18 to 45% on normal tax brackets is income tax. So the change here is that, unfortunately, that is not taxable in the individual's hands anymore. It's taxable in the trust now. So the distribution can still go to the individual, but it will not be taxed to the individual. So that's the biggest one. And I think what needs to happen here is definitely some planning around that, tax planning for your trust. And we can certainly assist people with that tax advice and just planning around that. So that's a big one that changed. And then also, obviously, the two-pot system that we'll discuss a bit later, that will have a lot of effects on people and perhaps not so much right now, but I think if you go a bit longer term, you look at 5 years from now, people immigrating, there will be things to consider. And again, tax planning that needs to happen.
Yeah. So again, and it seems like a relatively small topic to discuss is, if you have a family trust that you have set up for succession planning for your family, And a trust can't die. It's a juristic person. So because of that, it wouldn't be liable for estate duty. So SARS is now saying, well, if the beneficiaries want to enjoy the benefits of the assets held in the trust, then the trust should be responsible for the taxation, not the beneficiary, which again is to raise tax revenue, because trusts, their levels of taxation are at 45%, where people's range from 18 to 45%. Um, so
I
let's go ahead, sure.
just want to add on to that. The main reason for that change is to get more tax. Because what happens when you have a non-resident beneficiary and you do the distribution to them, if the trust has interest income and that's being distributed to the non-resident beneficiary, they don't pay tax in South Africa on interest earned. They have an exemption. So SARS definitely loses out on income there. They then have perhaps rental income, which the profits would then be distributed to the individual beneficiary, which they don't earn other income in South Africa. So they automatically pay tax on a lower tax rate on that rental income. So there is a lot of loss in tax when it comes to distributions to non-resident beneficiaries, which is why obviously they have been looking at changing that.
Yeah. Again, trusts were clever a couple of years ago. And so it will be interesting once all of this comes into effect, the new sort of methods that people will be pursuing for preserving legacy and also income tax mitigation. So one of the big changes that actually it came into effect in April of last year, but this is now obviously in full force for the current year of assessment. So when you were previously moving money out of South Africa, I'm sure most people on the call would be aware that, as an individual, you could move R1 million a year out of the country without needing a tax clearance certificate. You could just do it. But if you wanted to do more than R1 million, you would have to seek, tax clearance certificates and South African Reserve Bank approval, all that sort of thing. What they have now tried to do is to simplify things and move it away from being two separate application processes between the Reserve Bank and SARS, and making it into a very simple, streamlined process. That's the way they've sold it. But what comes with this is, once you have a more simplified process, they're now asking for additional information, information that they previously wouldn't have asked for. And the reason that this affects non-residents specifically is you don't have that R1 million allowance as a non-resident. It's from every R1 that you want to send out of the country, you have to go through this new process called an approved international transfer. So Marisca, could you walk us through, from an administration point of view, what are the changes and what are the things they're asking for now, perhaps that they weren't previously?
Okay, so firstly, I just want to start with saying that I get so many people saying they've heard that they are not allowed to send funds out of South Africa anymore because they are non-resident now. Or the second one is that we don't need to do a tax clearance anymore because we're a non-resident. So there's a lot of misinformation as well out there. So you are allowed to send funds out of South Africa as a non-resident, and it's a lot like the previous. I mean, you do have a tax clearance certificate for up to 10 million rand. The one that falls away obviously is your 1 million rand, which was quite a nice little amount there to just freely do some transactions. But now from or the first round, like you say, you need to do that. So the changes really between the old process and the new process is that there used to be two separate applications: a foreign investment tax clearance, which is just when you wanted to do investment offshore, or as part of your immigration. Mostly you would have used this if you have your retirement annuity that you want to cash out. So you would have done the immigration process. They've combined this into one application now, and it's called the Approved International Application, and it distinguishes between a resident and a non-resident. So when you're a resident, the process is a lot like the previous process, where you can just do it, you need your supporting documents, and obviously they do ask different extra questions, which I'll get to now. But when you're a non-resident, you can do the AIT application. You just need to prove to SARS that you've ceased tax residency. So this also, we found a lot more people needing to apply for the cease to be resident declaration and getting that notice of non-resident, because before you could have been living in Singapore for 10 years and never told SARS that you ceased residency because you never needed to, and you just sent money out every year, you know, with your foreign investment tax clearance. But now to get money out of South Africa, you have to actually cease your residency, and that's one of the supporting documents in applying to send funds abroad. So that's been a big change in terms of when we mark that person as a non-resident, we first need to go through that process. So this also adds on time, because now you thought, oh, I want to send money abroad. Let me quickly do a tax clearance certificate. I know it takes a month, but now it takes a month and a little bit extra, because you first have to seize your residency, which takes a month. Sometimes if SARS delays a little bit longer, so the process can be longer. So my advice to anyone is, living abroad, if you haven't seized your residency yet, just do it. Get your notice of non-resident, so that when you want to send funds abroad, you already have your supporting documents. You don't then have to first go through the process.
So we're going to get into the whole process of ceasing residency and the steps you have to take, and some of the considerations you should have in doing so. Ceasing residence is important if you live abroad, but there are still, you know, considerations of how, when, why, all that sort of stuff. So we'll get there. But the big thing that they didn't ask for before is they want a statement of your assets and liabilities for worldwide assets, split between local and foreign assets, where previously they only wanted to know local South African assets and liabilities. And I'll ask the audience, why do you think they're asking what you have offshore? I think we know the answer. But to that, they also ask, and the anti-avoidance with trusts, the rules that are coming into force now, has been supported by this new process, because there are additional questions that they ask, such as, are you a beneficiary of a local or foreign trust? Have you made loans to a local or foreign trust? Or do you have direct or indirect shareholding in a legal entity of 20% or more? So if you have an offshore company that you've been using to invest or hold assets, if you want to move money out of South Africa to reach that corporation to then be invested elsewhere or whatever, they want to know about it. And these, like, again, are not things they previously would have asked for.
Yeah. So as well as a part of this, when you are a non-resident and you are applying to send funds abroad, you must also send them your capital gains tax calculation of when you ceased residency, because obviously the consequence of ceasing residency is that you have to pay your exit tax. So as part of the 2 extra documents that you need to supply when you are a non-resident is your notice of non-resident and your capital gains tax calculation. And then they will also go into your tax return to see if you have actually declared and paid the tax.
Now, with all this being said, you perhaps having alarm bells ringing and thinking, right, every time I want to move money now, they're going to be asking questions, and I could be potentially on the hook for a fortune in taxes. All I can say is, if you have a really good tax team and a good administrator, and you have gone through the right processes and you keep up to date with all of this, I'm not saying that you have to go through and take the time to read this in detail to build these sort of documents that Marisca and I have built here for you. But what I'm saying is, don't be afraid of this. If you take action and you seek advice, you will be protected, and the cost of advice will be way less than the bill. Sorry, the cost of advice will be way less than the potential tax bills. So what I'm trying to reiterate is, it sounds complex, it sounds scary, it sounds like they're coming after everything you have offshore as well, but do not be afraid of this. It is just simply it is something that you need to be abreast of, and working with a good team who can show you what to do. And if there are potential disputes, or if they are claiming taxes payable that are not payable, then the good tax team will be able to also dispute those and provide the evidence to, one, mitigate that liability, or potentially just get rid of it, because it could be wrongfully charged. So that's the ART process. Marisca, do you have anything else on this you'd like to share before we go into
Yeah.
two?
I just want to maybe give them some peace of mind is that when you cease tax residency, you are only subject to tax in South Africa on your South African source-based income and assets. So if you paid your exit tax when you left, and you now want to do your AIT application and you have to provide information on your foreign trust and your foreign companies, SARS can still not tax that income because you're a non-resident, and none of that is taxable in South Africa, only your South African source-based income. So local trust, local companies, if there's any income deriving from that. And then secondly, if you didn't inform SARS of your capital gains tax and your exit tax, we can assist you to apply for a voluntary disclosure application where you will have your penalties waived. So it's not all doom and gloom. There's a lot that we can do for you to help you.
And let's say that you left 5 years ago and you've accumulated a huge amount of assets and you haven't ceased your residency yet. Now you're thinking, right, I'm going to have to pay capital gains tax on all my assets that I've accumulated since I've been abroad. You can backdate your ceasing of residency. When this all came to fruition in 2020, 2021, and started becoming of importance, I'd already been living overseas for 4 years, and Marisca just backdated mine to 2016 when we went through the process. So really nothing to stress about too much. So moving swiftly along, and I know there's going to be a lot of questions, guys, but what we're going to do is we're going to get through these two new processes or the new things that are coming in, and then we'll pause, and I'm open to taking questions before we get into the next stage of this evening's discussion. So the next process is a two-pot retirement system, and this might sound, if you haven't heard of it, you think this is a new thing. No, it's not a new thing. It is an extension of something they introduced previously. And if you look at this little picture, on the 1st of March 2020, they announced that you're going to have 1.25 million rand as a foreign employment income exemption. Anything after that could be liable for income tax. And this was the beginning of the kind of the changes that affect non-residents. And what we then had in March 2021 was the introduction of Provident Fund annuitization as part of the harmonization of retirement products. What does that mean? The harmonization of retirement products is simply saying that there are mainly three types of retirement products in South Africa: a retirement annuity, a pension fund, and a provident fund. Each of them have different rules. A retirement annuity and a pension fund are usually things that you would seek by yourself independently, that you would take out and purchase. A provident fund is something that's usually provided by an employer and that you and the employer both contribute to. Now, pension funds and retirement annuities were largely treated the same way. When you reach retirement age of 55, you could take 1/3 of the money that was in there, take it as cash, and you could take 2/3 and invest it into a compulsory living annuity. And the word there, compulsory, is important because it's by law you had to buy an annuity to provide you an income in retirement. Provident Fund was different. A Provident Fund, they understood that people would leave their companies and perhaps they might want to have access to those funds when they left. So before retirement, a Provident Fund, you could take the full lump sum, not which you couldn't do with others with pension or retirement annuity, and fully withdraw that. It would be taxed at higher rates, at the withdrawal tax rates. But basically what they have now said is, right, we're going to change that. There are going to be two pots within your provident fund, and you'll have a vested pot and an unvested pot. In the vested pot, it will have all the same rights and all the same rules that you're already familiar with. And you have an unvested pot, which now would be treated very similarly to a pension fund or a retirement annuity. This is what they call the harmonization. Now, they've gone further since they initially introduced this in March 2021. And from the 1st of September 2024, there's new rules coming into effect. Now, I know I spoke a lot there. So, Marisca, would you like to go into the changes that are coming in for this year?
Yes. Okay. So these are on all the products. So it relates to pension funds, provident funds, and retirement annuities. So on the 1st of September 2024, these policies will also go into a two-part system, but really it's a three-part system because you get your vested part, which whatever value is in your products on the 31st of August 2024 will go into a vested part, and all the same rules that currently apply to them will continue applying to those products. And you'll have those values and everything continue as normal. Then your second part, or then we go to the unvested part, which has two components really, which is your savings component and your retirement component. So as of the 1st of September 2024, all the contributions that you are making towards your retirement products will be split into these two components, where 1/3 will go into your savings part and 2/3 will go into your retirement part. Your savings part, you can access every year, so you can withdraw from that part. It has to be a minimum of 2,000 Rand, and whatever you can go up to whatever the value is in that. So it's once per tax year, you can withdraw from that part, and this will be taxed at the normal tax rates, where usually your retirement products are taxed on different tax tables, where this is risky because now you're going to start taking money from your retirement pot and it's going to add to all your other income that you receive, and it's going to increase your taxable income and you will be paying tax on that. We're not 100% sure yet, and the fund houses don't know yet, so it hasn't been introduced, but they are talking of a withdrawal tax. So we believe that there might be either a tax directive system or a withdrawal tax system where before they actually pay your savings out to you, they will withhold the tax on that. And this would be like, then I think when the tax actually gets assessed at the end of the year, they'll do the final calculation. But we don't have enough information now to really say how that's going to work. So that's your savings part that you can access. Then you've got your retirement part where the other 2/3 of your contributions would go into this part, and it would, at maturity age, you would have to buy a compulsory living annuity with this. So just to put this into perspective, currently how it works is if you have a retirement annuity, you can only withdraw this at the age of 55. And 1/3 goes into, you can withdraw as a lump sum. So this is now your savings part. And the other 2/3 you needs to go into a living annuity. So it's the same as that. It's just your savings that you can now access throughout your lifetime. On the 1st of September, they will also allow a transfer of seed capital from your current value. So it would be a seed capital transferred to your savings part. It would be 10% of the fund balance up to a maximum of 30,000 Rand. And the reason why they're doing this is because if you're only going to start doing savings from the 1st of September, you can't really withdraw anything for a while. So they were nice and they said, okay, well, we give you 30,000 Rand that you can withdraw, but they weren't that nice because there's a whole lot of other things that happens because of that 30,000 Rand. And I'm sure, Michael, you want to go into that.
Look, I have a lot of opinions here, but I'm gonna try and stay professional. But in the long term, what I see this as is you are going to be giving people annual access to their retirement products up to 1/3 of their annual savings, basically. And if they do access all of it, a minimum of 2,000 Rand or more, it gets added to their income. It gets added to their normal rates of taxation. That would potentially allow for what you would call as income tax bracket creep, where you move up to the next bracket where you potentially wouldn't have just on employment income. You are now paying greater amounts of tax while depleting your future retirement benefit. Whereas previously in the previous system, you have less access, but if you were to access it, it would be taxed in a separate table to your normal employment income or gross income, and it would be taxed at potentially a lesser rate. So one, it increases access, so people are going to take it because they can. And two, it increases the amount of tax that you pay, which is who's that good for? It's wonderful for government because people are going to take the money, they're going to pay more taxes, it's going to raise revenues, But in the long term, think about how this pans out in the next 10, 15, 20 years when people are desperate and they don't have sufficient income. They're going to be touching on this more and more and more each year. And what's going to happen is these same people will not be able to retire. And then they could be potentially more dependent on the state, which means we'll have even more issues and the government's going to have to raise even more income tax and taxes from all sources. So is this a positive thing? Potentially. I mean, it's going to help people who are in need, but it'll help them today and potentially not tomorrow or their future selves or their children. Because the money that remains for example, in a retirement fund, when you pass away, that can move to your family without having to be factored into for estate duty. The more money that you have in there, that's a useful saving when you pass on to and give it to your family, versus now there'll be less in there and potentially more in your estate, which will be taxable again and at between 20% and higher, depending on your size of your estate. So again, another way for them to be raising revenue. But this is all as it applies to residents. And this is all as it applies to people who are retiring in South Africa. And this is all as it applies to people who are going to be drawing from these while living in South Africa during retirement. If you are a non-resident and you've been out of the country for 3 years or more, you are eligible, once you have ceased your residency, to withdraw your funds. Now, when you withdraw it, obviously there's a lot of considerations into this. That's why we've done previous webinars just on that topic. But basically, there are ways that you can withdraw from them and mitigate the amount of taxes paid, get the money out, get it in an unrestricted investment vehicle offshore in hard currency, US dollars, euros, pounds, and you have discretion with it. You can do with it as you like. Whereas in these models, you will be subject to these sort of rules, restrictions. And if you wanted to draw from them, if you wanted to access them in retirement and send them to yourself abroad, you would have to follow the previous process we just discussed. And you have to do that annually. You would have to do an annual income tax assessment and all of that. If you aren't returning to South Africa, if you have no intention to return, if you hold these investments and products, it might make sense for you to review all of them, understand how they work, understand how these changes can affect you, your family, and your situation, and understand how to bring those offshore to make sure, or to leave them there. I've also told a few people to leave them there because they intend to return. So again, it's very subjective, depends on your circumstances. But as a non-resident, you have options. You have the ability to make decisions and to remove your life savings from there if you want to. So again, I think I wanted to end there just by saying it sounds scary. It sounds like a potentially like a red flag, but as a non-resident, you have options. And Marisca and I have sat and helped lots of people to understand all of this. It takes a couple calls because it's a lot to wrap your head around. But yeah, we're here to help you to understand that. So Marisca, I did tell you I was going to rant on that a little bit. Do you have anything else you'd like to add on the two-part system?
No, I think we covered it all. I think for anyone who's already a non-resident, it doesn't affect you unless if you are still contributing, in which case I would say perhaps consider stopping your contributions before that happens. And then also, I'm not sure if it affects anyone who's a non-resident yet, but you don't have to withdraw from your savings pot. So you can at any time as well, whatever goes into your savings pot, you can transfer that tax-free to your retirement pot. And that can then be taken out when you can withdraw your retirement. So for a non-resident, the advice that I would give is in the year that you cease tax residency, you can take anything in your savings pot, but that will be taxable at a higher rate. So I would suggest let's wait for the next year where you don't earn any other income in South Africa. So automatically you'll fall in a lower tax rate, or transfer that tax-free to your retirement pot. And in 3 years from there, you can withdraw that as you do the rest of your withdrawal pot. So again, tax calculations would need to be done to see what's going to be higher, your normal income tax rate or the tax tables between 18 to 36% if you withdraw it from your retirement annuity. So there's a lot of tax planning that can happen. So yeah, I think that's just something to consider. It's not, again, all doom and gloom.
Yeah. So guys, we've covered quite a lot of detailed information. These are really the two big pieces that people need to be aware of. We've got quite a bit more to discuss in terms of the process of ceasing tax residency. What does that entail? That'll come in the next section of the talk. But I wanted to open the floor now if there's anyone who has questions or if they want to I don't know, just ask an opinion on either of these two processes, please feel free, put it in the chat and we can address it. But equally, if there aren't any questions in the next minute, I'm conscious of people's time and I don't want to keep them from their families or their work day. So we'll move on. So we'll give it a minute. And it is the most awkward 1 minute ever to sit here. Right. And according to my computer, that's 1 minute. So moving on. Guys, if the questions come through, please, I know it takes a while to type out what you're thinking as well. Right, Reese, you've asked a good question. How is the exit tax calculated? It's coming to you in this section. So we'll get into exit tax. What is that? How is it calculated in this section now? So first of all, what is ceasing residency? Why is it important? What is the background of all of this? This is a very, very wordy page, but essentially, in 2020, they introduced changes to the exemption on foreign employment income. And they said, okay, you can earn income up to 1,250,000 Rand. Anything over that, we will tax it at a marginal rate from 18 to 45%. So a lot of people said, oh, I don't earn that much. Maybe, so I don't have to do this. Well, you still should, because that means you are a resident, because that rule only applies to South African tax residents, regardless of where you live. So that means for all intensive purposes, for everything that you do and all these previous things that we've just discussed, you are deemed to still be a person living in South Africa, which leaves you open to a lot of potential taxation. So then what happens is you would say, okay, well, I can just enact a double tax agreement between where I'm living and South Africa to protect myself. Now, that's well and fine if there is an existing double tax agreement, which there are many. But if you're living in a country that does not charge income tax, like the Middle East, then potentially that also falls away. So that is really the background of ceasing residency. But Marisca, before we go into what are the steps, how do we calculate exit tax, do you want to come in and chime in a bit more about why this is such an important thing for non-residents?
Yes, Michael. So to start with, it's an obligation in terms of the Tax Administration Act, is that when your registered particulars change, you need to inform SARS within 21 working days. So it's really an obligation, and it is in your best interest to do this, because in most cases, especially people living in Singapore, you are going to pay more tax in South Africa. So if you had to say that I want to use the 1.25 million Rand, only that part will be exempt, and then the balance will be taxable in South Africa up to 45% tax. And I know that your tax rate is much lower than that. So the balance will be taxable in South Africa, which is just unnecessary. And then on top of that, you get so many exemptions as a non-resident that you can utilize, where if you deem yourself as a tax resident while really being physically present in another country, you are losing out on a lot of exemptions that you can have. And then thirdly, the things that we look at when you cease tax residency or how you cease tax residency is, first question is, what is your intention for the future? Do you ever intend to return to South Africa to live here? And if you don't, then you are a non-resident. Then you cease tax residency whether you want to or whether you plan to or not, you cease residency. Then secondly, if we do look at the double tax agreement, it says that you become an exclusive tax resident of the jurisdiction where you are a tax resident. So you could become a tax resident of both countries, because in Singapore, if you spend a certain amount of time, which we'll go through just now, then you'll become a tax resident. But then because of the double tax agreement, you'll become a tax resident of either of the countries. So you cease tax residency whether you plan to or not. If the double tax agreement and legislation deems you to cease tax residency, you are obligated to inform SARS.
Now, we're going to get into double tax agreements and how those work just in a little bit. But basically, there comes to it, there's a TARS test, a sufficient TARS test. And there's a lot of things that go into that. But if you're residing in a foreign country, the chances are you're going to meet the sufficient TARS test. They're going to apply the double tax agreement. And only the amount of taxes that you were taxed in the country of residence is deductible. But if you are, let's say you pay 22% tax in Singapore and you have 45% tax in South Africa, that means you're taxed at 23% basically on the difference in a way. I mean, you would have to calculate it to get the exact percentage, but that's the way to think about it. And as Marisca says, it's unnecessary taxation. It's tax you don't have to pay. And you know, Singapore tax treaty rules, they look at you, they deem you to be an exclusive tax resident. So Marisca, do you want to talk a bit about the Singapore tax treaty? Or actually, let's zoom it out into tax treaties in general, because they are quite similar.
Yeah, so the tax treaties, each country has its unique set of rules of how you will become a tax resident in that country. But generally, it's about your physical presence in that country and the amount of time that you spend there. So for Singapore, there's two tests, the quantitative test. So if you're physically present in Singapore for at least 183 days, in the calendar year preceding the year of assessment. So if we now in 2024, if we look at the 2023 year of assessment, if you were there for more than 183 days, you do meet that requirement. Or if you exercise employment in Singapore for more than 183 days in the previous calendar year. So either you're physically present or you exercise employment there, you would become a tax resident. Or the qualitative test is if you reside in Singapore and your absence from Singapore is temporary and reasonable. So you permanently live there, but you travel for work every now and then, and it's not a permanent thing. So if any of these relate to you, then you would become a tax resident of Singapore.
And I would like to point out that you don't have to meet both these tests,
yes,
quantitative or qualitative. You meet just one of them, and you would be considered tax resident here. When you are tax residents of this country, they have an existing double tax arrangement with with South Africa, and you would potentially be protected. But that's only if you are deemed to be resident in both countries. But in this case, if you play it right, if you have ceased your residency, you could be exclusive tax resident of Singapore, which is favorable considering Singapore has no capital gains tax, it has no estate duty or inheritance tax, and income tax is far lower. So this is more into a double tax agreement, and in thinking about the time that we have left here, I would urge you, if you're interested in how it works, please do read through this. It is quite interesting in how they establish it. But since March 2021, how you leave the country and when you immigrate, there's a lot of things that have changed. There used to be this thing called financial immigration, which is really an old South African Reserve Bank process. And what has happened is that was phased out in March 21. And now it's been basically moved from a South African Reserve Bank process into an entirely South African Revenue Service sort of process. So what happens with all of that is you need to report, you need to let SARS know that you have left the country. You have to provide supporting evidence and documents that they request. At that point in time, you would pay a exit tax, and then you can withdraw all your money out of South Africa post-exit tax. And then you can eventually close all your accounts and all that stuff if you want to, and deregister for tax. So, Mariska, I know you do this every day. So please walk us through this whole process.
Okay, so basically you'll start with seizing your residency with SARS, and it's done by a declaration of seizing residency, and you'll have a lot of supporting documents that need to go with that application. And this overwhelms a lot of people because it's a lot of documents. But basically what they ask for, and this is just to motivate that you are actually in that country, you're allowed to be there, you're not coming back, and all of that information. So it's like your passport exit stamp when you left South Africa, your visa that allowed you to live in that country, or the current visa that you are on now, your travel diary, your tax residency certificate, which is only necessary if you don't break ordinarily resident. So if it's not your intention to return to South Africa, you break ordinarily residence, we don't need to prove that with a tax residency certificate, because essentially you then cannot be a tax resident anywhere. If you can motivate that you have no intention and a whole lot of other things, then SARS will give you this letter as well. So all that documents, your proof of address, and that declaration is then submitted to SARS. It takes 21 working days for them to approve this. Sometimes they do go over time, but then after that, they will issue a notice of non-resident letter, which would then be your official proof that you're a non-resident, and you'll need this letter for so many transactions that you do with South Africa. So that's the start of the process. It takes about a month. Then you would, depending on how long you've been out of the country, you can apply for an AIT in terms of immigration, and that would be if you want to withdraw your retirement annuity from South Africa. So then you'll apply for the AIT application. We facilitate the process to withdraw your retirement annuities from the fund houses. This is quite a complicated process and a lot of following ups, a lot of phone calls, a lot of emails. We have a person specifically sitting the whole day just phoning the fund houses. It's not fun doing this yourself. So we help you with this just because we understand the funds by now. So we facilitate with withdrawing the process, and then the tax directives with SARS, and then opening a non-resident bank account, because the fund house will only pay this out to a non-resident South African bank account. So we can assist with that process as well. And then once it's approved, paid out to your non-resident bank account, you can then have the funds sent abroad. So that's then your residency seized, your RA has been withdrawn, and then it depends on where we are in the process. So then you have to submit your tax return to declare this RA withdrawal. And then if you've got no more income and assets left in South Africa, you can deregister your tax number. But then let's say now you have ceased residency, you've done your cease to be resident declaration, but you haven't been out for 3 years yet. Then after that, the process kind of pauses there for you. You continue to submit your tax returns in South Africa because perhaps you earn some interest, or you've got, retirement annuity contributions, and SARS is aware of this. They're going to want you to submit your tax return. And the rules with SARS is if you don't earn any income, there's a lot of rules where you don't have to submit a tax return. And even though this is SARS's own rules, they give our clients admin penalties for not submitting their tax returns. So my advice to clients is, please submit your tax returns, even if it's 0 returns. It's going to cost you so much more to do this, because if you don't submit that tax return, SARS levies an admin penalty. And to get rid of that admin penalty, you'll have to submit the zero return anyway, and we can then dispute that admin penalty for you, which sometimes our fees is higher than the actual admin penalty to do that because of the time involved in it. So just do a zero tax return or submit a return if you've got interest only. And you do that for the remainder of the period while you're waiting for your 3 years to be over. Then you withdraw your retirement annuity and go through that whole process that I just explained. And then once that's withdrawn and you then at that stage have no more income and assets, you can then deregister your tax number, which we assist with. Or if at this stage you do still have assets left because maybe you've got a rental property that you're still renting out, or you've got South African bank accounts earning interest, even though you're not subject to that tax in South Africa, you still need to declare it to SARS and then apply the exemption. So then you'll remain a taxpayer, but you'll be a non-resident taxpayer, just meaning that none of your foreign earnings will be taxable in South Africa, but whatever you earn and have left in South Africa will be taxable here. And until the stage where or for as long as you still have income and assets, you will have that active tax number and must submit tax returns.
So guys, it sounds quite complicated, and it is, but it's simple. You provide evidence that you don't live in the country. You tell SARS that you don't live in the country. You go through this process. They will ask questions. And there's a potential exit tax. Now we've received some questions here about how is this exit tax calculated. So let's go into that quickly. So we have a page dedicated to that. So the consequences of ceasing your residence is it triggers what's called an exit tax. And all that means is that whatever your assets are at the date that you ceased residence, the capital gains tax becomes due and payable at that point in time, whether you've disposed of the assets or not. So basically how it's calculated is they will look at the market value of those assets and your cost price for those assets at the point in time that you ceased your residency. And that's when they will calculate how much capital gains tax is applicable at this stage. So basically, if let's say at that date, then you ceased your residency, but it's backdated. You can then go for the voluntary disclosure program that Marisca explained to avoid any penalties that could be liable for late tax on that gain. So now if you have other assets in South Africa, if you have investments, if you have insurance policies, if you own property, if you can still cease residence, you can still live abroad. And I always give the example, think about it this way. If you were a German person who's tired of the winters in Berlin and you fly to Cape Town for a summer and you get to enjoy Stellenbosch and the wine farms, and you decide to buy a vineyard to visit once a year, does that entitle SARS to tax you on your income in Germany? And the answer is no, it doesn't. So if you take that concept, you apply it to yourself and you say, right, I am a non-resident, but I own assets in South Africa, then you can still cease to be resident. And these are excluded from the capital gains tax calculation for when you're ceasing your residence, because whether you're resident or not, these are taxed the same way at disposal. When you come to sell them, the capital gains tax is calculated the same way, resident or non-resident. So that is this section here where you can see immovable property, interest in discretionary trusts, and certain employment equity instruments. These are not taxable when you go through the exit tax process. Did I cover that okay?
Yes. So in summary, what we look at when you cease tax residency is basically your investments and shares and unit trusts, those kind of things, local and foreign, and then also your foreign property. So those are mostly the things that come up when people need to pay exit tax. Or if you have vested rights in a trust, which most people don't have because their trustees are very clever in the way that they've set up the trust. So yeah, that's what we look at. But something that's very important when it comes to this is that, again, we come back to trust, is that For succession planning, you have your assets in your family trust and you've always planned to keep it there. And then when you're going to sell your property in the future, you're just going to do the flow through principle, and the beneficiaries will receive this distribution and pay the capital gains tax in their own capacity at 18%. But when you're a non-resident, it's not taxable in the non-resident beneficiaries' hands anymore. It's taxable in the trust hands at a flat rate of 36%. So that's double the capital gains tax you pay when you sell an asset through a trust. So again, if you haven't yet cease tax residency and you're planning to cease tax residency and you do have a trust, do get tax advice on that before the time, just to plan properly for what is going to happen to your trust, and maybe rather vest so that you can pay this before you cease residency rather than later at a higher rate.
So again, that only applies to people with trust. It's a serious consideration because it literally doubles your tax burden. But
Yes.
For everyone else, normal people don't have trusts, and they've just got, you know, a bank account, a retirement annuity, an insurance policy, and their old house they used to live in before they moved abroad, and now they're renting it out. You can still cease your tax residency, and at that point in time, there would be no exit tax or CGT liable on your movable property. But then your other assets, your investments, that sort of thing, there could be potential capital gains tax to pay on those. Obviously, there's an annual exclusion that we're all entitled to, but it's a very small amount. So, yeah. Now, the difference with, and we're hitting time limit here, guys. So please feel free to send further questions about this topic in. But let's just now talk about a retirement annuity. Once you have ceased your tax residency and you've been abroad for 3 years, you are entitled to withdraw your retirement annuity in full. Not 1/3, 2/3, not your savings pot, not your vested pot, not any of your pots. You just take the whole thing. And when you do that, it will be taxable at withdrawal rates, which are higher. And those are these rates here. So from 0 to 18% to 125, sorry, to 27% to 36%, depending on how much you withdraw. That would be the tax rate for the retirement annuity. Now, whether you are over 55 or under 55 and you choose to pull your retirement annuity out in full, then this would apply to it. But if you choose not to withdraw it in full and you decide to take 1/3 out as cash, that would be taxable at this rate, depending on how much it is, and also depending on if you've ever taken any other previous withdrawals. And then the remaining 2/3 would be put into this compulsory living annuity. Once it goes into that product, it can never come out. You can never take it out. You have to draw it down gradually. And that has limitations in itself, in that you can only draw a maximum of 17.5% per year from a living annuity. So if it's your life savings and you're never going back, putting it into that product, you're limited on the amount you can withdraw. You're exposed to the devaluation of the rand, and that all of that income is subject to South African income tax. So extremely cumbersome process. And then if you want to remit that money abroad to where you're living, further cumbersome process. So again, considerations here for when you withdraw. Now, when you have a provident fund and you're over 55, there are different considerations for withdrawing those. We won't get into that today. So we are at 5 minutes past 1 o'clock in South Africa and 5 minutes past 7 here in Asia Pacific. We have a whole section that we've devoted to frequently asked questions. A lot of things, and I get asked this all the time. If I cease my residency, am I still a South African citizen? Yes. Your green mamba, your passport, it will be stuck with you until you find another passport. But your tax residency is a different thing. You can be a tax resident in a different country and still be a citizen of South Africa. Now, you can go through all of these questions, guys. Another thing, there used to be, and I also receive this often, is what happens if I return to South Africa after ceasing residency and it's been less than 5 years? That used to be called a failed immigration. That got phased out. It's no longer a thing. If you've ceased residency, you can return at any time. There's no ramifications for doing so. Must I sell my assets? You can retain them as a non-resident, but you will just pay tax on them. And okay, double tax agreements we've gone through already. This is what happens if you do not have a double tax agreement, which thankfully in Singapore we do, and in other countries in China and Hong Kong and we do. So, but if you're in the Middle East, you can read this. And what if I receive an inheritance from my parents in the future? And I'd like to spend our last few minutes just talking about that, because I think most people on the call would receive something from their parents, albeit a small amount or a great amount. Mariska, what should people consider here with residents, non-residents, and receiving inheritance?
So they have simplified it a bit over the last 5 years. And again, there's been so many changes to this, but the current legislation says that if an immigrant can prove that they have ceased their tax residency with SARS, so they've got that notice of non-resident letter, or they've got a notice of deregistration of their tax number, if they've got that proof, any of those two, the Reserve Bank will allow them to externalize their inheritance. So if someone is receiving an inheritance, when they haven't yet done this, then first we need to do this whole cease to be resident declaration for them, and then they can externalize their inheritance. But then you also get South Africans who's never been registered for tax because either they were children when they left, or maybe they were students and never worked and they left. For them, the process is different. They don't have to register for tax just to get that cease to be resident declaration or a cancellation of tax number. They can externalize their inheritance. If the amount is below 10 million Rand, they don't need any approval. The Reserve Bank will allow that to be externalized. If it's above 10 million Rand, we will need to apply for a manual letter of compliance from SARS. But again, don't need to register a tax number. It's just the letter where SARS will allow that funds to be externalized.
Awesome. So now the last page. And please remember, everyone, you will get a copy of this. And if you are simply watching the recording when this is live on our YouTube channel, you can write us an email and we'll provide it to you. Our contact information is right here. If you want to speak to Marisca directly about your tax situation and ceasing residence, about moving money out of the country, the process to follow, but also a whole host of other things. She can act as a trustee on your family trust if you'd like her to. She can help companies do their annual audited returns. She can do most things tax related in South Africa. Please do reach out to her. Her email address is here, mintaccounting.co.za. And Marisca always offers very kindly a free 30-minute consultation to all of the South African Chamber of Commerce Singapore's members and listeners. So please take her up on that, and she can hear you out and see if she can help you. For myself, I'm based here in Singapore. I'm in the time zone of Asia Pacific. Anyone across the region who is looking to understand the things we've discussed here, how it relates to their situation, where they're living. Also, the idea of where to save your money. Do you send it back to South Africa, or do you keep it abroad? What do you do with it when it's abroad? I can help you understand that. Retirement planning across multiple jurisdictions is what I try and help people do, as well as succession planning. If you have assets in the UK, South Africa, and where you're living at the moment, be it Singapore or abroad, there are some considerations there that you need to be aware of in terms of how do you pass those on to your spouse or to your future children. And I can help you understand all of that. Further to that, retirements, annuities, pensions, products, all that, pretty good at that. And between myself and Marisca, we'd be able to help you save tax, and would be able to, well, hopefully save tax and help you to get these funds out of the country. So with all that being said, please visit the South African Chamber of Commerce's website for more upcoming events like this. We do great in-person events too, and we hope to see you all at a future event. Marisca, again, it's our 5th year doing this. Thank you for your time and your willingness to support our community out here. Any closing words to you?
You're so welcome, Michael. I really do enjoy doing this, and my main thing always is just to help people, and especially to help them with finding comfort and not be fearful. So I'm really excited to speak to any of you. If you have any questions, please do email me. I'm happy to jump on that call with you, like Michael said. So please do reach out.
Awesome. And with all that being said, guys, I see we don't have any other questions coming through. We'll leave it there. Any questions, please drop me a message or an email. Or tomorrow we'll be following up and sending you the e-guide on an email. You can reply to that with your questions, and we're here to help. Have a good night, and thank you for joining us.